Welcome back to the deep dive. Today we're digging into the source material to bust a really big myth in personal finance. The idea that you need like a ton of money just to start investing.
Oh, absolutely. That myth keeps so many people on the sidelines. It's just not true anymore. We looked at guides, reviews of apps, all focused on starting small. And the message is loud and clear. There's this whole approach now called micro-investing, basically using small, regular amounts to actually build significant wealth.
Exactly. And that's what this deep dive is all about. We want to give you a clear, friendly roadmap if you're a beginner. It's about getting your money working for you like right now. Even if it's just 20 bucks, maybe 50 bucks a month. Automation in these new platforms make it possible.
Yeah, we're definitely not talking about get-rich-quick schemes here. This is the opposite. It's about getting rich slowly, reliably, building that foundation.
Okay, let's unpack this then. How do you turn that spare change into, well, serious growth? There are really three core ideas that make this whole micro-investing thing work for pretty much anyone.
Right. And we absolutely have to kick things off with the tech that really blew the doors open for beginners, fractional shares.
Okay, fractional shares.
Yeah.
Sounds a bit technical, but it's revolutionary, isn't it? I mean, back in the day, if you wanted, say, one share of some big company or an index fund.
Yeah, to buy the whole share. Yeah.
Exactly. If it cost, I don't know, $400, you needed 400 bucks right there just for that one single purchase.
Which just locked out millions of people, didn't it? Fractional shares. They're standard now on most modern apps. It just means you're buying a piece, a slice of one share. Think about it. This wasn't even possible when everything was paper stock certificates. But now the brokers, they handle splitting it all up digitally. It's easy.
So, right, instead of needing, what was the example, like $237 for an S&P 500 fund share, you can just say, look, I've got 10 bucks I want to invest today. And the broker just takes that $10 and buys you $10 worth of that fund, like a fraction of the share.
Precisely. And here's why that's so powerful for someone starting small. It means every single dollar you deposit gets put to work immediately. Like in your old example, if you had $200, but the share cost $237, your $200 would just sit there doing nothing, earning zero. With fractional shares, every penny starts working right away. It maximizes your growth potential from day one.
That makes sense, getting every dollar working instantly. And that leads right into the second big concept, doesn't it? The engine behind all long-term growth, compounding, the non-negotiable power of it.
Compounding. Yeah, often called the eighth wonder of the world, and for good reason. It's not just about earning returns on your initial investment, your principal. It's about earning returns on the profits you've already made. So your money makes money. And then that money starts making more money. It just accelerates exponentially over time.
Okay, let's make that real. The sources had a great example, right? Imagine someone commits to investing just $50 a month. $50. That feels doable for a lot of people, and they do this consistently for 20 years.
Right, so $50 a month for 20 years. If we look at the stock market's historical average return, let's say around 10 or 11% per year. Over those 20 years, the total amount you actually put in out of your own pocket is only $12,000.
12 grand. Okay, that's the money you earned and saved. So what does the compounding magic do to that?
Well, thanks to that snowball effect, that acceleration we talked about, that $12,000 investment could grow to roughly $43,700.
Wow, hold on. From $12,000 invested to over $43,000. So like $31,000 just appeared from growth?
Exactly. Over $30,000 earned without you lifting another finger, just because your early returns started generating their own returns.
Okay, $43,000 starting with just 50 bucks a month. That totally changes things. The big takeaway there has to be that the time your money spends invested is way, way more important than how much you start with, isn't it?
Absolutely. Which brings us perfectly to the third pillar, because let's be honest, who can manually remember to invest exactly $50 every single month for 20 years without, missing some?
Life gets in the way.
It does. So you have to take yourself out of the decision-making loop. You need automation.
Okay, here's where it gets really interesting. Because the whole point of micro-investing really is to make building wealth automatic.
Yeah.
Systematic. Almost boring in a good way.
Definitely. And we found two main types of automation that just build wealth quietly in the background. The first one, and honestly the most critical, is recurring deposits. This is just setting up an automatic transfer. Maybe it's $50, maybe $100, whatever works for you. It moves straight from your checking account to your investment account on payday. Boom. Invested before you can spend it.
Simple but powerful. Okay, what's the second type? The one everyone thinks of with micro-investing.
That's the roundup investing feature. You link your debit or credit card to an app. You buy something, say a coffee, for $3.25. The app rounds that purchase up to the nearest dollar, so $4, and that extra 75 cents, it gets automatically swept into your investment account.
Investing your digital couch cushion change,
Yeah.
basically.
Pretty much. Now, whether you use recurring deposits, roundups, or both, this automatic approach lets you do something called dollar cost averaging, or DCA. Forget the fancy name. What matters is the behavior. By investing the same amount automatically, regularly, you naturally buy more shares when prices dip low and fewer shares when prices climb high.
Ah, so it takes the emotion out of it. You're not trying to guess the perfect time to buy.
Exactly. It completely removes that stress of trying to time the market. So many beginners get paralyzed, right? Waiting for that perfect dip, which never quite comes. Automation just makes it consistent. It removes the angst, ensures you keep investing, and maximizes that compounding effect over the long haul.
Okay, that makes a ton of sense. Fractional shares let us start small, compounding grows it big, and automation keeps it going.
Hmm.
So now the practical part. Where do we actually do this? We looked at the brokers and apps the sources reviewed. What were the key things they looked for?
Yeah, the criteria were pretty consistent. Things like, what can you actually invest in? Do they offer fractional shares? That's a must. What are the automation features like? And crucially, what are the fees? And what kind of accounts can you open? Like a retirement account versus a regular one.
Right. So how did the options shake out? Can we group them somehow?
Yeah, I think we can put them into roughly three buckets. First, let's talk about the sort of long-term heavyweights, what the sources often call the big three.
Okay, who are they?
Fidelity, Vanguard, and Charles Schwab. These are the massive established brokerage firms.
Got it. So if you're thinking long-term, maybe setting up an IRA you'll have for decades, these are the go-tos.
Absolutely. They offer pretty much everything under the sun. Roth IRAs, traditional IRAs, accounts for kids' education like 529s, even business accounts, you
Yeah.
name it. Their selection of investments, stocks, ETFs, mutual funds, bonds is enormous. And for their core index funds and ETFs, the fees are often rock bottom or even zero. Fidelity, for instance, literally has funds called zero index funds, zero management fees. You can't beat that.
Zero fees is pretty compelling. Okay, so they're maybe a little less flashy than some apps, but they're built for the long run.
That's the idea. You can grow with them basically forever. But, okay, let's look at the next group. The apps that are really laser focused on that set it and forget it automation, the specialists.
Right. Who stands out there?
M1 Finance and Acorns were mentioned a lot. M1 Finance has this unique pie system. It's very visual. You basically create a pie chart for your investments. You decide, okay, I want 50% US stocks, 30% international, 20% bonds, whatever. Then, every time you deposit money, M1 automatically splits it and invests it according to those percentages. It keeps your portfolio balanced automatically. Instant diversification.
Huh, that pie thing sounds pretty neat for keeping things balanced.
Okay.
But fees, there's always a catch, right? What did the sources say about specialist fees?
Ah, yes. This is critical, especially for micro investors. M1 Finance, for example, they charge a $3 monthly platform fee if your account balance is under $10,000.
Okay, wait. $3 a month. If I'm only putting in, say, $50 a month, that $3 fee is eating up 6% of my investment right off the bat, before it even has a chance to grow.
Exactly. That's a huge drag on small accounts. Those fees can absolutely crush your early gains. Acorns, the other big specialist known for roundups and ease of use. It's great for building the habit, super simple interface, but they also have monthly fees. Starts at $3, can go up to $12 depending on the plan you choose.
Right. So if my roundups only total like $15 in a month and I pay a $3 fee, I've lost 20% just for using the platform. Ouch. So the takeaway is these specialist apps might be great for getting started and automating, but you really have to watch those fees until your balance gets bigger.
Precisely. The fees are manageable on larger accounts, but they can be a real killer when you're just starting with small amounts. Which brings us to the last category.
Okay.
The app's designed for the absolute simplest start. Like for someone who just wants to dip a toe in, minimal friction, super easy interface.
And who fits that bill?
Robinhood came up again and again. It's almost universally praised for having the cleanest, easiest to use app. Very intuitive. Fractional shares start at just $1. So it's arguably the lowest barrier to entry just to, learn the ropes, see how buying and selling works.
Makes sense. Any unique features there?
They do have an interesting IRA match program right now. They'll actually match a percentage of your contributions to a Robinhood IRA. I think it's 1% for free members, up to 3% if you pay for their gold subscription. It's essentially free money for your retirement, though you do need to be aware of holding periods. You might have to keep the money there for, say, 5 years to get the full match.
Okay, so Robinhood sounds like maybe a good place to start, learn the basics, maybe get that IRA match. But the general advice from the sources was maybe plan to eventually graduate to one of the big three like Fidelity or Schwab once you're more comfortable and your portfolio is growing.
That's exactly the consensus. Use the simple, sleek app to build the habit, get comfortable. Then, for long-term security, zero-fee funds, and the full range of account types, move over to one of the big, established institutions.
That sounds like solid advice. All right, we've covered the concepts, the tools. Let's nail down the actionable steps. If someone listening wants to start today, what's the roadmap? Like 4 clear steps.
Okay, step 1. Before anything else, get your financial house in order, especially high-interest debt. We're talking credit cards mainly. If you're paying 20% interest on a credit card, paying that off is your best guaranteed return. No investment is going to reliably beat that. So tackle that aggressively first. Now, you can start micro-investing small amounts while you're paying down lower interest debt, like a car loan or student loans. But high-interest debt is priority number 1.
Got it. Pay off the expensive debt first. Makes sense. Step 2.
Step 2, open the right type of account. This is usually where people get a bit confused, especially about taxes. For beginners, it typically comes down to 2 main choices. There's the Roth IRA, which is usually the best bet for beginners saving for retirement. The money you put in has already been taxed. It's post-tax. But the magic is all the growth, all the compounding we talked about, and importantly, all the withdrawals you take out in retirement are completely 100% tax-free.
Whoa, hang on. So that $43,700 example from earlier, if that $12,000 was invested in a Roth IRA, the $31,000 plus in gains, I pay zero tax on that when I retire.
Zero. Zilch. Nada. That's the massive advantage of tax-advantaged accounts like a Roth IRA. The alternative is just a standard taxable brokerage account. With those, you will owe capital gains taxes on your profits when you eventually sell your investments. So yeah, for retirement, especially for beginners, the Roth IRA is almost always the way to go. And you can open one online super fast, like 15 minutes with Fidelity, Schwab, or Vanguard.
Okay, Roth IRA for tax-free retirement growth. Excellent. Step 3.
Step 3. Keep it simple and diversified. This is huge. As the sources stressed, you're not trying to pick the next winning stock. That's incredibly risky, especially for beginners. Your goal is just to capture the long-term growth of the overall market.
So avoid putting everything in one company's stock.
Please avoid that. Instead, focus on low-cost, broad-based index funds or ETFs. Exchange-traded funds, things like an S&P 500 ETF, common tickers are VOO, IVV, SPY. Think of it like buying a tiny piece of the 500 largest companies in the U.S. all in one go. Instant diversification. It's the simplest, most reliable starting point.
Simple, diversified ETFs.
Got it.
And the final step, step 4.
Step 4, go fully automated. This is probably the single most important habit. It ties everything together.
Setting up those recurring deposits we talked about.
Yes. Set them up immediately. Pick an amount you genuinely won't miss. Even $20 or $50 a month is a fantastic start. Set the frequency, maybe line it up with your payday, and then just let it run. Let the wealth engine work in the background without you thinking about it. If you only do one thing after listening to this, automate your investing. Step 4 is key.
Okay, so to recap, we've defined micro-investing, seen how fractional shares make it possible, understood the incredible power of compounding over time, and looked at the platforms built for easy automation. If there's just one single thought you want our listeners to take away today, maybe something to really act on, what would it be?
Look, the overwhelming message from all the sources we reviewed is crystal clear. The biggest mistake you can make is simply not starting, waiting, feeling like you need to be some kind of expert or already wealthy. It's just procrastination, really. Investing small amounts isn't about getting rich overnight. It's about building that incredibly powerful habit of consistency. It's about letting time, not trying to time the market, do the real heavy lifting for you over the years.
That's really powerful. The best time to start was years ago, sure, but the next best time is definitely right now. So if you're ready to finally open that account, set up that automation, definitely check out the source material we used for this deep dive. We'll have links and details on the platforms and tools we mentioned. Thank you so much for joining us for the deep dive.